we're going to talk about navigating private markets. Private markets is a place that many people are interested in, but want more knowledge about and want to be able to understand kind of what the opportunity set looks like and how it differs from public market investing. So I'm Josh Hile. I'm the co-founder and CEO of Citizen Mint. Prior to starting Citizen Mint in May of 2022, I was the director of investment strategy and research at Laird Norton Wealth Management, which is about a $15 billion, $16 billion wealth manager in the Seattle area. I was responsible for the worldwide sourcing and ongoing due diligence and monitoring of public equities, infrastructure, real estate, private equity, private debt, and venture capital. So I had a lot of work in doing manager due diligence and just understanding and figuring out who the best managers in the space are specific to private and public markets. I also spent some time at Russell Investments in a similar role, doing manager research on top managers in the universe and helping big 401k and pension fund clients with their investments. So let's talk about just what is private versus public market differences. So we'll look at specific to ownership and access. So say in the private markets, it's typically going to be limited to investors who meet certain asset thresholds. These are going to be accredited investors. So what the SEC is really trying to say here when they make these requirements is that you have enough money to lose as an accredited investor. So usually you either are making a very high salary or have $1 million in assets. And they're saying that people with that amount of assets can lose that and be okay instead of an average investor. In public markets, it goes through an IPO process and it's more accessible to all investors. And that would be just considered traditional markets. Another difference is liquidity and volatility. So in private markets are typically going to be illiquid and can last for several years. But this also results in usually lower volatility. There's not constant pricing within the market of these particular assets. So you're going to see a lot lower volatility on how the values change. Whereas in public markets, these are highly liquid investments. They're going to be subject to market fluctuations. They're going to be subject to investor sentiment. So if investors are feeling poorly about the market environment, they're going to be probably selling their stocks. If they're feeling good about the market environment, they're going to be buying stocks. And then kind of the third big difference is diversification and values alignment. So in private markets, usually there's some lower correlation to the stock market in general. And then there's also a greater ability to align capital with your specific values. Whereas in public markets, they're going to have high correlation. So stocks, even if one stock is doing well from a business perspective, it's probably going to be caught up in the sentiment of the day and could do poorly in a poor economic environment. So you're going to see those stocks move in tandem in most cases. There's also a more limited ability to provide direct impact on specific issues. If you think about housing affordability, which is one of the issues that we deal with across the country, there's not really a specific REIT you can invest in where you can address housing affordability in a real way. You really have to do that through private market investments. And then I wanted to talk really about kind of the opportunities in private markets, which this is going to be just a short list of the opportunities, but it's pretty significant. And this should encompass roughly 90% of the opportunities out there. So one is private real estate. Two would be private infrastructure. Three, private equity and venture capital. We also have private debt as well as natural resources. So again, there's plenty more you can invest in within the private space that isn't perfectly going to fall under one of these categories, but this is really going to be 90% of the investable opportunities that you have within that marketplace. So for private real estate, this is going to be, say, multifamily housing, office, commercial, or industrial properties. In private infrastructure, what that really is long life productive assets that have really strong pricing power in their market. So these are going to be think of these as roughly monopolies or quasi-monopolies. This could be say a utility within a particular market that's producing energy. It could be a wastewater treatment plant. It could be battery storage. It could even be things that might not even be, or that could be like toll roads, could be considered private infrastructure. Private equity and venture capital is going to be capital that's put into a business to grow it, make it more efficient or profitable. And then that business is going to be either IPO'd in the case of venture capital in the future, or maybe bought through an M&A transaction, or it's going to be likely in private equity, you're probably going to have a strategic purchaser after the company has become more efficient or has grown over time. Private debt is really loans or other forms of debt financing that aren't provided by banks or government entities. There's a lot of private debt within the US because there's a lot of banks that won't loan to certain specific opportunities. So say for private equity, most of the private equity transactions actually happen through a private debt provider. And it's usually called direct lending within like kind of the institutional and private wealth space. For natural resources, this is going to be agriculture products, commodities, or land that has the potential to increase in value over time. This could be investing in, say, agriculture, where you're planting new crops and then you're looking for them to mature and then kind of sell off, like, say, like an apple orchard. You're planting it, waiting 5 years for it to roughly mature into bigger trees, and then you can start getting the full net operating income of the sale of those apples. It could also just be like commodity mining or anything else within that specific sphere. There's really 5 key benefits to private markets. There's many others that we could talk, but here's the 5 that I think are the most important. One is really diversification. So with diversifications, these are places where these are uncorrelated assets, usually within the market, and they can reduce the volatility of your portfolio and create different return drivers. So when you're building a portfolio, you're really trying to say, okay, what are my return drivers over time? And I kind of want differentiation in those return drivers. So when stocks are doing poorly, maybe my bonds are doing well. When stocks and bonds are kind of going sideways, I have other return drivers, maybe like some private debt within my portfolio that's just providing me with consistent income over time. So you just kind of want those different diversification mechanisms within a portfolio. They also, in many cases, have higher return potential. So private markets have produced higher returns than traditional stock and bond markets. So, and they've been allowing the investors to capitalize on that differentiated source of return. We've seen this in private equity over time. So private equity has had between 14 to 16% returns over, say, the last 30-year period, which has been higher than the 8% that you would have received over that same period, say in the S&P 500 index. And it's that differential is really called the illiquidity premium. So you get a premium for holding things that aren't liquid, where you're trying to find inefficiencies within the market. There's also a big due diligence payoff. So there's about a 10% difference between the top quartile investment managers and the bottom quartile. This is just very different than public markets, where if you're investing even like in an active manager that's picking stocks versus an index, maybe that differential is like 50 basis points, 1% over time. But in private markets, like picking the best managers and being with the best investment teams can be huge to your ultimate return payoff. So that's what we really focus on at Citizen, is like thinking about due diligence and doing really strong due diligence on these managers over time. There's a long-term focus within private markets, which is great. Most stocks are bought and sold within 12 months based on the most recent data. And that's just really not a long-term focus on the business and growing the business. So, and private markets can really take advantage of swings in asset values over time. So what we expect from our managers is them to take advantage of this by, selling when the market's up and pricing is up on the specific assets they hold, and then buying when we go through dips in the market, say like 2022 or earlier this year, where we expect managers to be putting capital to work to say, hey, this is a great opportunity. These assets are off 50% from where they were in 2021. We should be buying them. So many people expect like 2023 to be a really strong year for investing in private markets in general. You can also have a very specific targeted impact, and I kind of mentioned that earlier. Private markets really give the investor the ability to select opportunities that align with their values and interest areas. Which is just not as available within the public market sphere. So if you want to affect affordability, if you want to affect education, healthcare, climate change, you can really do that in a very specific way in private markets. So one of the things I wanted to provide is just touch on a couple of those points with actual data. So private markets can provide significant stability during downturns, and this is a chart that is out there within the marketplace that shows kind of how private markets perform versus the S&P 500 during different times. Now, this is based on the valuations at that specific time. Private markets are not priced as much as, say, the public markets. So there is this kind of what is called unrealized volatility, where maybe the pricing was down, but because they're holding it for a long period of time, that asset didn't get repriced within the same time period. But we have seen over time that these assets do stay steadier to within a specific band. So where you're going to see public markets maybe drop 20 to 40 up to 40% during a recession, you'll probably see those more private market opportunities drop 10 to 15%. And they have a little bit more mechanisms to help in like keeping those assets stable over time. Also, to the due diligence payoff discussion that I had, this kind of gives you the returns and the significant difference in returns between picking kind of the top tier managers within a specific universe versus the bottom tier managers. And you can kind of see that's huge within, say, a private equity, where there's a 20% difference between like top tier private equity managers and the bottom tier. And you see it kind of across the board within real estate, within natural resources, within infrastructure. You're going to see this in a consistent time period. And one of the things I should mention, just since we're on this slide, is kind of give expectations around the return for these. You kind of see some of the kind of the median returns of these different asset classes. But in general, private equity is expected, and that could include venture capital within that specific bucket. They just put private equity, but it does include venture capital. That's really expected to be, kind of your highest risk return asset class within the private markets, and you're expecting between 15 to 30% returns within that specific asset class, and like really the 30% returns coming from venture capital opportunities. But that will also be dependent on when you invest in those opportunities. So vintage year or the year you're making the investment is incredibly important. If you think about venture capital firms who invested, say, in 2021 at kind of the peak of valuations, they will have a little bit harder of a time in the future, and maybe their returns might be a little bit lower because they bought those companies at a much higher price, whereas VC firms or venture capital firms that bought in the current time frame are probably buying at lower valuations. They're getting a bigger chunk of the company. The companies are much more efficient, and they're probably going to see higher returns in the future. For private debt, it's really going to be between probably more actually closer to 8 to 14% for the private debt sphere. And I say that because interest rates have gone up more recently. So it has increased the returns of private debt. In private real estate, the average return is going to be about 10%. But the big differential there in private real estate is what you're actually investing in. So are you investing in like core real estate, which is just buildings that have already been built? There's not a lot to do to them. That's probably going to be an 8% return opportunity versus more development projects within that, where you're taking on a lot more risk, and you expect that that's going to be closer to 14 to up to 30% IRRs. If you're on the very high end, it's a little bit harder to get that at the current point in time, just given the interest rates. For natural resources, it's kind of been hit and miss over time. Farmland has been somewhere, a place that has been a bright spot within that, and timberland, just given the increase in prices there. And then from an infrastructure perspective, which is something we're very passionate about, the returns of that asset class have also increased more recently as a result of the Inflation Reduction Act. But you're really looking at returns between 12 to or 8 to say 14, 15%. If you're doing a much higher risk development project within that, you might be getting up to the 20% range. But in a lot of cases, those are pretty secure projects where you're investing in a real asset that you're putting in the ground. So from a due diligence process, this just is giving you a quick summary of kind of the things that you would do within due diligence for private markets. You do an initial screening, essentially understand what the marketplace looks like. You would do a thesis review of like, why is this an interesting opportunity at the current point in time? So say for, real estate, like what are the best opportunities within the real estate market at this point in time, and why do we want to invest in them? Well, multifamily might be an interesting opportunity because affordability is really tough within the market, and there's not a lot of multifamily being built because it's really hard to get financing for these projects. So that would be kind of the thesis around it. Then it would go into a qualitative due diligence of like the specific managers that you're reviewing. And so you're essentially understanding, like from a qualitative perspective, how talented are these employees or these investors compared to other ones you could invest with. And then you also do it from a quantitative perspective of like, what's their performance track record been? Do they have some sort of differentiation in the marketplace? Do they have some differentiated information sources or opportunity sets that they get to look at compared to other players in the marketplace? And then finally, it goes into an operational review. And the operational review is making sure you're doing background checks on the specific individuals, understanding like that their money is going to the appropriate places, that they have like a back-end administrator, that they have compliance teams who are checking on that they're doing what they're supposed to be doing and what you would expect them to be doing over time. And that's like the main 5 kind of steps within due diligence. So as I noted at the beginning, there is this ability to align capital with values, and kind of want to give some just overview on the ways to do that within the private market landscape. So there's 3 kind of main categories that we would look at. Private debt would be up here on the top left-hand corner. And so you could invest in micro lending. You could do community development loans, which is usually loans within a specific community to help it develop or help it thrive. It could be mezzanine debt for affordable housing. If you look at the bottom left-hand side of this circle, there's really real assets. So this could be investing in renewable power. It could be investing in affordable housing. It could be investing in agriculture or timberland investments. And then on the right-hand side of this diagram is venture capital and private equity investing. And this is where you can also get pretty specific into some very specific issues. So whether that's around education, sustainability, circular economy, water, there's just a lot of different ways you can invest to align your capital with your values within the private markets, which is what we like. And I think there's also been a talent influx within this particular area of the market. If you look at the marketplace in general, like most big asset managers have come into the market with some of their best investors, whether that's KKR, Apollo, Bain, Wellington, Texas Pacific Group, or TPG, and have all put multi-billion-dollar impact funds together. So there is this kind of combination of talent and then opportunity. And they're doing that really because the opportunity set is so big in all these places, multi-trillion-dollar opportunities within renewable energy and other places. So key terms to know in the private market landscape, one would be our IRR. So this is essentially the internal rate of return And it just really measures the profitability of a specific opportunity that you're investing in. And you can compare IRRs of multiple different projects. And IRR really needs to be taken into account with multiple on invested capital, which is the second. And this is just the multiple of capital that you expect back on your original principal. And I say they need to be taken into account together is because IRR also takes into account the time frame. So if you have, like, say, a 12% return on an opportunity, but you get it over a half a year period, that would be closer to like a 24% IRR just because of the time period. But you really only got 1.12 times your money on that specific opportunity. So you have to take both into account, so that multiple on invested capital as well as the IRR when reviewing different projects. And most people like thinking about what's going to be the actual return in my bank account, what's going to be the multiple on the money I'm making. There's called GPs and LPs in most opportunities you'll be in. So the GP is a general partner, and they're responsible for managing the fund. So they're the person responsible for investing the capital that you put with them. And then LP, or limited partner, are the investors who are going to contribute capital but have limited liability and control over the fund. So this would be the ultimate investor says, I want to give my money to this specific person because I believe they're a talented investor. I'm going to become a limited partner. Like, whatever happens within that fund, I'm not liable for that. But at the same time, like, because I just want to get the returns that the general partner can give to me. Liquidity is the ability to convert an investment into cash. Again, private markets are mostly illiquid, so you should expect to be in these opportunities for 3 to 10 years at a time. And so liquidity is a huge concern, where people say, when am I actually going to get my money back? Is it going to come back in chunks? Is it going to come back all at once? And how fast can I get it back? And then capital calls. This is something that's very, very common within the private market landscape. The investment manager doesn't want to have all the capital with them at once. So they will say up front, maybe we're going to take 50% of your capital and make an investment. And then as we make investments after that, we will continue to call capital. So that could be on a quarterly basis. It could be on a half yearly basis or a yearly basis. But in most cases, they won't take all the capital up front. They can, say, if you're doing a multifamily development and they're going to put all that money into construction. In other cases, with private equity and they're buying companies over time, they're going to call that capital right before they buy a company. So the main risk to private market investments, which is something you should always be thinking about and looking at, there's illiquidity and exit risk. So a lot of these investments are not easily bought and sold and are dependent on like a very specific buyer interested in the assets at the appropriate price to sell an investment. So with any investment, it's going to be partially dependent on the market environment. So you will have a market environment that's really good, and you can sell investment because there's lots of buyers within the market who are flush with capital. Or in a market environment similar to today, you have to have investors who are willing to take a little bit more risk and also be able to get the financing to be able to purchase those investments. So there is this illiquidity and exit risk within markets, and usually you have to wait for good times for an asset to be sold. There's also can be a lack of transparency. This isn't always the case, but they're not always going to have stringent reporting requirements to show you everything that's underlying the fund. Or in some cases, you put money into what's called a blind pool fund, where you don't actually know what they're going to be investing in. That would be the case with like venture capital or private equity funds in most cases. Like, you don't know what they're going to be investing in, but you're trusting them that they are talented individuals who will be able to find the best opportunities for your capital over time. And then there's concentration risks. So private market investments can be more concentrated in a certain particular area of the market, which is why diversification is key when investing in this asset class. If you think about, you want to invest in a venture capital opportunity, this would likely have some tech specific concentration within that. So it might be, SaaS technology fund in a lot of cases. So you're going to have a lot of concentration with whatever happens within the tech sector. If you're investing in specific to real estate or industrial real estate, you're going to have a lot of concentration within that specific part of the sector. So you just have to be able to diversify across multiple sectors within this particular asset class. At this point, kind of open it up to questions. You can use the Q&A box, and then we can go through like any kind of discussions or opportunity or things you want to know more about the private markets. But that's the broad level overview. Obviously, you can dig into each one of these topics in significant detail, and each one of these like kind of investment asset classes in significant detail. But I'm gonna just open it up at that point in time. So I think one of the questions was just around how do you actually invest in these opportunities? And so this can be done in multiple different ways. There is platforms that allow this, say like Cadre or Yield Street or these other kind of platforms that are looking to provide some broader access. A lot of this private market investment is done through like the wealth advisor channel. So, as part of your broad portfolio plan, you can utilize your wealth advisor to help with like finding private markets that fit into your liquidity profile, your risk tolerances, and kind of meet your goals and objectives for your long-term planning, whether that's growth or income or capital appreciation of your portfolio, and kind of also understand like what is interesting to you from a values alignment perspective. So that would be, and they like wealth advisors usually have access to platforms like Citizen Mint that can help them in that regard and help them provide them recommendations for their individual client portfolios. And one of the other questions is just about like what are the best kind of or what are pertinent opportunities within the space at the current point in time. And what we've seen more recently is really a couple like bigger opportunities specific to like renewable infrastructure has been one thing that's continued to be really interesting just because it has that defensive nature through market environments. We've kind of gone through an interesting time period where the Fed has increased rates quite dramatically. We've gone through a significant inflation. And so we're still kind of seeing if it's going to be a soft landing or a hard landing, if we are going to have a recession or not. But that doesn't really matter for the renewable infrastructure space because these are long duration assets where there's significant demand either for energy or waste to value, which is recycling, or other kind of like parts of that like infrastructure space. And one of the things that really happened over the last year that really changed the dynamics of this space was really the introduction of the Inflation Reduction Act. That added about 2 to up to 6% returns to infrastructure returns, which was pretty dramatic just because of how big that package was and how much tax incentives are in that package. On top of that, there's a lot of tax benefits to be invested in renewable infrastructure because of the special depreciation you can take on these specific assets. So over the first 10 years of the assets, you can depreciate them. And then a lot of that kind of return that you're expecting from an operating income perspective off the assets is going to be untaxable because of the depreciation essentially shielding it. So we really have found that to be an interesting asset class just for the current market environment. Let's see it. Oh, can you explain cash on cash is? Yes. So cash on cash is usually just a measure within real estate. And so like when you put say $100,000 or $10,000 into an opportunity, that's your principal within the real estate opportunity. And cash on cash is really after people pay rents, the expenses are paid. what is the actual cash flow that I can get back into my pocket? So if I'm getting $1,000 in cash flow a year from the $10,000 I put in, that would be a 10% cash on cash return from that specific project, which would be high within the real estate marketplace, but just as an example. And then how has technology helped give more access to these type of investments? Great question. So with technology, we've been able to like essentially take out kind of the pain points within these investments. I think the real issue for these investments has been that they're cumbersome for most investors. So you have to go find the investment, fill out these subscription documents, do due diligence, and that has been a process. And then you have to like report on it, do like tax reporting. And so we've been able to essentially like, or many within the marketplace, but we specifically have tried to take out all those specific pain points where we can make it super easy where an investor can invest within just a few minutes into these specific opportunities. They can go through the back end, like know your client, anti-money laundering, these things that the government requires when you're transferring capital, as well as from an operations perspective, filling out subscription documents automatically, having it all be on DocuSign. You'd be surprised at how many managers still have you fill out subscription documents manually and sign them with ink and have you fax them in. Whereas we've taken that whole cumbersome task and made it so it's super easy on the ultimate investor. Also, like with technology, we've just been able to decrease the cost of the administration of these products, which can be significant, and been able to like bring that to so that it can go to a broader group of individuals. So instead of having, say, $250,000 or $500,000 minimum for these projects, we can take that down to $25,000 and make it just a small percentage of your portfolio, and be able to like really access it and be able to diversify across a number of these different opportunities. And most of these managers that like we provide access to is really managers that you wouldn't be able to access on your own. They're usually only dealing with pension funds or big like institutional investors in most cases, but like we can aggregate capital and make it easy on them and do it in a scalable manner for thousands of investors.